This meeting is being recorded.
Okay, thanks so much, everyone, for taking the time to meet with me today uh, for Principles of Accounting 2. I am still your host, Dr. B. Happy to have you with us in a very virtual setting. The past week or so has been a little bit complex because of timing with a lot of things, and I'm currently in Medellin, Colombia, uh, working on a big project here for accounting, doing research with a very large, well, I won't say large, but with another university, and it's through the Fulbright program through the U.S. Department of State. Very meaningful research. The reason why we were unable to have the live class last week was because I was flying on that day, and it just wasn't going to happen because the timing just didn't work out. But I'm glad that we're able to make today work. So thanks so much for joining me. Um, so today we're already in week 13, if you can believe that or not. The time has gone by so fast, and it continues to increase in speed, in my opinion. So here's what we got going on for this week. We're going to have a nice, fun discussion on incremental cost, the relevant cost and decision making type of thing. For this week, we have a LinkedIn Learning Certificate. This one I like a lot. It's called Cost Based Strategies or Cost Based Pricing Strategies. This one's fun because in business, setting the right price for products is like so critical, because if you set the price too low or too high, it can really mess up your business, right? Because when you set the price too low, that means you're not covering your costs. You set the price too high, you're going to scare away potential customers, right? So how do we find that balance? How do we price appropriately? That's what this LinkedIn Learning Certificate, in my opinion, does a great job of. And once again, with the LinkedIn Learning Certificates, you're able to showcase the skills that you learn by posting this to your LinkedIn account, and also you're going to earn the credit for doing it in the course like you have done in the past. So overall, I think this is a great value added for this course and for you. So please, that is your first action item for this week. Some of you have already done it. Thank you if you've already done it. You're saving yourself time, right? So we have the LinkedIn Learning Certificate, and we also have the quiz related to our discussion today. So those are your two action items for this week. Next week, I will try to hold the lecture as long as I can get back to the apartment on time. I think I can, but things are strange here sometimes. But I'll try. I'll try my best to make sure we get next weekend, because next week we'll do the final chapter of our text, which is the chapter 26, and this one is good too. It kind of like wraps everything up, and so I think that one's going to be really important. And then the following week we'll do a quick. There's a This one is a QuickBooks paper that you'll write. Everything you need to know is in here. So you go into action expression. I have a lecture posted for it, for the paper and the final exam, and then I also have the paper instructions here, and that's found in week 15. So if you're interested in seeing what that looks like, go ahead and open it up. It won't hurt you. There's nothing scary in there. Don't worry about don't you know click on open attempt or start attempt or whatever it's called, just to look at it. It's not going to hurt. So that's where we are. That's where we're heading. So let's jump into our conversation today on relevant costs for management decision making. And a lot of this has to do with uh, what we've already talked about when it comes to identifying costs for production. We talked about things like um, our raw materials cost, our direct labor cost, our factory overhead cost. We talked about those in depth, didn't we? We analyzed those costs so much over the past 12 weeks. We've also did a lot of deep dives into related costs, fixed costs, mixed costs, variable costs, and the like. And so, what this conversation today does is it helps us to kind of bring all of that together in a management decision making way. And we're going to take those things that we learned about before and put them into action. So here are a couple of really important decisions that that come up in management. The first one is called the make or buy decision. It's kind of like we can either make that component ourselves, with this direct materials, this direct labor, this factory overhead, we can make it ourselves, or we can buy the component from someone else that's already made, buy it off the shelf, or make it ourselves. The make or buy decision. That decision is in like so many examples in business. Do we make our own database software, or do we buy it off the shelf? Do we make our own component that goes into this automobile, or do we buy it from someone? Do we? So you see what I'm saying? But that decision comes up a lot. The other decision comes up a lot is to sell or process further. This type of decision is real common when it comes to process manufacturing. So think about oil, for example. I can sell the crude oil as is, or I can process it further. When I process oil further, I can create what's called derivative. I can never say that word. I can't say it in English or Spanish. Derivative products means like we start with crude oil, or I can process it into gasoline, different grades of gasoline, or into kerosene, or into other types of fuel. Okay, so it starts with crude oil. That's the raw extract from the ground. Then I can process it into all these other things. So sell it as it is, or process it further. Type of decision needs to be made. And then other decisions like the sales mix with constraints. Should I eliminate a segment of the business or continue forward? Should I keep or replace a particular product? Should I? How do I figure out how much to sell it for? And then special offer decisions. Special offer like a contract comes in. Can you make this many products? Do I have the capacity? Type of special offer. So we'll talk about those cases as it relates to cost. So first we of course need to figure out what is the decision making process. What does it look like? So the first thing we do is we have to define what a decision is. Right? It's like, okay, so here's the decision we need to make. We have an opportunity to um, build this component ourselves or buy it as is off the shelf. So that's the decision. We define what is the decision we have to make. The second step is we identify the alternatives. So in that example of the make or buy decision, alternative one is to make, alternative two is to buy. Right? So what are our alternatives? The third step in the process of making the decision is to collect all the relevant cost information. Okay, so if I make the product myself, what are the costs involved? I have direct materials, direct labor, factory overhead. Whereas if I buy it, it's just the cost of buying it, right? So my relevant cost. Then I select one of the alternatives. The fourth step: select course of action. Select one of the alternatives. Do I make it based off of the cost information I have available, or do I buy it? And then, of course, the last step is to analyze and assess the decision that I made. Was it the right call? And if it wasn't, what changes do I need to make in the future to make the right decision? So that's the decision making process. Now, as it relates to the types of costs we are going to look at, in addition to the costs you already know about, we're going to examine uh, incremental costs. We'll also examine incremental revenue and incremental income. The word incremental simply means additional. The word incremental simply means additional. The additional revenue, the additional cost, the additional income. Think about, for example, the make or buy decision. If I make this product, what are my additional costs, my incremental costs? It's maybe a little bit more labor, maybe a little bit more whatever, right? If I sell this additional thing I made, how much more am I actually going to make? What are my sales going to be if I sell one more item, one more unit? That's additional revenue. The additional income, additional revenue minus additional cost, the additional net income, right? So all of these incremental uh, components come into my decision-making process. Now, of course, the decision I want to make is what's best for the company. And in that case, it's always going to be whatever decision makes the most incremental income. So at the end of the day, my net income needs to be higher. In business, we make the decision based off of that, with the end game in mind, right? Now, thinking about those incremental costs, we also need to think about what are relevant costs and irrelevant costs. Relevant costs impact the decision. If it's relevant, it has an impact on the decision. If it's irrelevant, I don't need to consider it. Relevant costs I need to consider. Irrelevant costs I do not. So here are a couple of examples of relevant and irrelevant costs. The first example is called a sunk cost. The sunk cost is a cost that happened in the past. It cannot be changed. Sunk cost happened in the past. Cannot be changed. Guess what? It already happened. I rented the building to produce the products. That's a sunk cost. Can't do nothing about it. I've already paid it. I've already made the decision to do it. I can't change it. That's a sunk cost. So that's an irrelevant part of the decision making. If the cost already happened, or if it cannot be changed or avoided, then it's irrelevant, not a part of the decision making process. The rent has to be paid regardless of what I decide to do, if I decide to make or buy the product. The next example is called out of pocket cost. This requires a future outlay of cash. Out of pocket. I need to pay it out of pocket. You see, take the cash out of my pocket and pay it. Out of pocket costs. Out of pocket costs are very relevant. It's relevant because it's going to happen in the future, and it's part of my decision making process. For example, the make or buy. If I make it, I have out of pocket costs of direct materials, direct labor, factory overhead. If I buy it, my out of pocket costs are the cost of buying it. right? So out-of-pocket costs come into the decision-making process. Therefore, the costs are relevant. The third example is called an opportunity cost. This is the potential benefit lost by taking an action over the alternative action. Looking at the make or buy decision. The opportunity cost is the one you did not select. So if it costs less for me to make it than it does to buy it, I'm gonna make it. The opportunity cost is the cost of buying it, right? It's the cost you did not select. That is a very relevant cost because it's involved in the decision making process and it has a direct impact on the decision, right? Opportunity cost. The fourth common type of cost to consider here is what we call an avoidable cost. Can be eliminated by choosing one alternative versus another. Going back to the make or buy decision. If I can avoid having to buy the product and paying more than it would for me to make it, then that's an avoidable cost. It's something I need to consider. Another example of avoidable cost is when we need to make a decision to eliminate a product line. It's like, oh, you know what? For give you a classic example, Peloton. I don't know if you're familiar with the company, but they make stationary bicycles and treadmills and other fitness equipment. And they use like an application or whatever. You get like a virtual coach and whatever's. So they recently had to make a decision of what I call an avoidable cost decision. They lost a lot of money. They're losing a lot of money making this treadmill or whatever it was. And every unit that they made, they lost like $2,000. So they're, in other words, they were selling it below the actual cost of making it. That's obviously a problem in business. And so the avoidable cost would be, what cost can I avoid by eliminating making that treadmill? You see? So that's a relevant cost, something to think about in the decision making process. So now that you have an idea about those, let's go through those common decisions that management needs to make based off of these costs. So the first is the make or buy decision. Do I make the product or the part in-house, or do I buy it off the shelf? Now, there's a couple of things that we need to look at when we make this decision. We have a couple of things here to understand. We have the direct materials, direct labor, and the factory overhead. You know that already because that's what goes into the cost of making a product. Okay, so here are the things. Here's the information. We currently buy this part for $1.20. We can make it for $1.05. This includes direct materials, direct labor, and incremental overhead. There's that word incremental. Each additional unit that we make, right? So here we have the information laid out in front of us. On the left side we have make, the right side we have buy. So there's a clear decision here, right? The company needs to make more money, more revenue. How do we do that? A couple ways. We have a higher sell price, or we need to cut our cost by paying less, right? So here we have a very clear decision. Cost me $1.05 to make, or if I buy it, it's $1.20. That's a difference of 15 cents, or a variance of 15 cents. So in this case, I'm going to make the part all day long. It's going to save me 15 cents. That makes sense. Now, the reason why overhead is incremental only, not the whole overhead, you might be wondering. Because, as you know, overhead includes other things like rent, maintenance, equipment depreciation expense, um, things like that, right? Those are sunk costs. The rent is a sunk cost. The depreciation expense, sunk cost. The maintenance, that's a sunk cost. I was already doing those things, right? I was already paying those things. Therefore, it's not a part of my decision making process, right? I'm only
Is
forward looking.
so
Leland,
so is I'm sorry, I didn't mean to interrupt you.
no,
So
you're good.
are you saying for like anything where it's like it's absolutely necessary for the product is basically a sunk cost? That's something that you have to do anyways.
Pretty much, yeah. So like if you think about this, let's say we have the manufacturing facility. It doesn't matter if I'm going to make or buy it. I still have to pay the rent on the facility,
Exactly. Okay.
right? It doesn't
Hmm.
matter if I make or buy it. I still have to pay the utilities. It doesn't make or
Gotta keep the lights on.
got to keep the lights on. I gotta keep the equipment up to date. I still have the depreciation for it. It don't matter. So
Hmm.
some cost is an irrelevant cost. As it relates to overhead, I'm still going to pay the rent. I'm still going to pay the lights. I'm still going to pay the maintenance. So, therefore, we only consider incremental overhead in the decision making process, if that makes sense.
All right.
It's
Okay.
the additional overhead for making each
Okay.
unit.
Anything additional on top of what's already is
You
considered,
got it.
would that
That's
be?
called
Yeah.
incremental. So anything
Yeah.
additional to what we are already paying is called incremental.
Yeah. Got it. Thank you.
Awesome. Very cool. Great question. So yes, in this case, the decision would be to make it because it'll cost us 15 cents less if we make it. We're going to save 15 cents per unit. Now, the next common decision is to sell as is or process it further. There's a couple of examples I could give for this. I already gave one about oil production. So if let's say I'm Exxon Mobil, okay, my business is extracting oil from the ground and processing it further into additional products to be sold. Right? I have the raw oil. I bring it to the refinery and I refine it. I turn it from raw oil into things like motor oil, process it further into gasoline, different grades of gasoline, process it further into kerosene and other heating products. So you see, like it's sell or as it is, or process it further. That's one example. Another example of this is what we call to rework it. Sell it defective or rework it. Make it better, and then sell it. Right. Example is a company creates this part. They realize that the part is defective. So what do we do? Do we scrap it, sell it as is, or do we fix it and resell it?
Fix it, resell it.
Maybe. It depends, right? It depends
Oh,
on
it
how much
depends.
more it's going to cost me.
Oh, yeah, obviously, yeah. Yeah, if it
Because
costs money, yeah.
right, because if it, but Leland, in that example, what we also need to consider are the sunk costs. I already paid a certain amount to make it the first time. You see, so those are sunk costs. The incremental cost will be the cost of reworking it. You see what I'm saying? So we'll talk about that one. That's a good one. But we got to decide, whether to fix it or sell it as is, or to decide to process something further and sell it as a different form of a product. So those are the type of decisions. And whatever is going to yield the highest income for the company is the one that'll get selected. So here we go. Here's that classic example. In this example, our company made a product, but the issue here is I can sell it as it is, or I can process it further. So let's use, I guess, the oil example in this case. I can sell the barrel of oil for $50,000 as is, or I can process it further into gasoline. If I process it further, I can get 150,000 for the barrel. Okay, the barrel cost us. The barrel cost us. How much it cost us? The barrel cost us. Let me see here. I guess it cost nothing. Okay. We'll sell it 50,000 as is, or we'll process it further. We process it further, it's going to cost us an additional $80,000, incremental cost, $80,000 in this example. I can yield $150,000 in revenue. So 150 revenue minus cost 80, net income 70. Obviously, I'm going to process it further because it's going to yield me a higher net income in this example of $20,000 additional, right? As if I was going to sell it as is.
See, Professor, I was right. No.
Exactly. You were right. You nailed it. I don't know how you must have foreseen this coming or something,
No.
but but you're right. And I would do the same thing as if I was reworking a product. So here we go, reworking a product. Same type of concept. Here we have a situation where we made this great product, and then all of a sudden we realize, whoops, we have defective in the process. So we made a bunch of these units, this part. We realized, oh my God, we screwed up in the manufacturing process. So now I have in my stockpile a bunch of defective parts that do not work. What do? I have to make the decision. I can scrap them, meaning sell them for the scrap value as is, right? Or I can rework them and make them work again. Okay? The decision, of course, is whatever is going to get the highest income. So if I scrap it, they'll give me $4,000. If I rework it, I can probably sell it for $15,000. However, the cost of reworking it will cost me an additional $8,000, in addition to what I already paid. But remember, what I already paid, that's a sunk cost. It's done. It happened in the past. It's sunk. Okay, I made the product, sure, great. I screwed up making the product. So in this case, the amount I spent on making that product the first time, that's a sunk cost. I'm not going to consider that cost in this decision of scrapping it or reworking it. I'm only going to consider the incremental cost of reworking it, in this case, an additional $8,000. But I can still yield a higher income if I rework it. So the decision here, of course, is I'm going to rework it. So and that'll yield me a very a variance of 3,000 in this case. So that variance is positive, and so therefore I am going to rework it.
Professor?
Yeah,
All right. All right. One more question. I was just wondering, what are the potential ramifications of a company, or if you're a business, inspiring business owner, but you always worry about the sunk cost, because it seems like it's great in practice, but I feel like a lot of people actually focus on that when they're making decisions.
It depends on the decision being made. So if I were, let's say I made a product, wasn't happy with the product, I wanted to work it further. The sunk cost does come in the back of mind, because that's the reality. Because you're looking at your income statement and you see all those expenses. You're looking at your balance sheet, you see them, right? You see what's going on, and so yeah, it's kind of at the back of mind, and it usually is. But we look at these decisions individually for what they are. We don't want to consider the sunk cost because if we do, that kind of clouts the decision making process. Because the reality is, we need to recover. We need to recover the sunk costs in the future, right? And so, in order for us to do that, we don't want to consider the sunk cost in the decision making process, if that makes sense. But I hear what you're saying because it's very real when you see those expenses. When you see like your direct materials, direct labor, factory overhead just kind of staring you in the face. It's like, hey, you want to do this again? You want to screw up one more time? It's like, yeah, that's a real thing. Um, but the reason why we don't consider it is because we really don't want to cloud the decision making process. Because if we did, Leland, the reality is, I I'd probably just scrap it. But then again, if I scrapped it, you know, I'm losing out on potential revenue by doing that. So we want to make sure that we cover for what we already spent.
Absolutely. I was just, yeah, making that understanding like, yeah, it makes more sense to go back and rework it and spend a little bit more money so that way you can make that money back. But I feel like certain people would probably just cut bait and
Of
just
course they
sell
would.
it.
Oh yeah, yeah. I know people like that. I've seen people do that, and I in business I try never to make hasty decisions because at the end of the day, you need to do what's right for the company, and if that means spending a little bit more, so be it. You got to do what you got to do in order to recover. But yeah, you're right. I've seen people cut their losses and say, "Oh, well, I screwed up. I'm just gonna mark that as a loss and move forward." Um, sure, but it's not always the best decision. It can cloud your judgment. It's a great conversation. So one of that actually leads me to one of our next parts of our decision making process is looking at our sales mix. So as you know, um, most companies they don't just sell one product or one type of product. They usually sell a lot of different ones. I brought up the story of Peloton, right? Um, Peloton they make exercise equipment. They call it smart, quote unquote, smart exercise equipment, right? Because they have a tablet or whatever hooked up to it. Anyway, they make the stationary bicycles, the elliptical machine, the treadmill, and probably a couple of other products. They're all similar in nature because they all belong to the same category of products, but they're not all the same when it comes to profitability. So we as managers look at those kinds of things in the decision making process. We look at what's most profitable in our sales mix. Looking at all of our product lines, which is making us the most money, and which one's making us the least. When it comes to production facilities for making those kind of products, like Peloton does, producing more of one product or over another usually means producing less of the other. So, like for example, if I know that Peloton their stationary bike is their most popular product, then they'll probably make more the stationary bikes than they will treadmills and ellipticals, right? So they'll probably focus more of their ability on making the more stationary bikes, right? So uh, we as management need to look at our product mix and figure out what's most profitable in order to determine our contribution margin on a per unit basis. So here we have an example of a company that manufactures, let's say it's Peloton, okay, and they make two types of their their stationary bike. One is called the Pro and the other one's called the Max. All right, so we have some data, manufacturing data on these. The Pro we sell for 500. We have a variable cost per unit of 350, giving us a contribution margin per unit of 150. Remember, sales price minus variable cost equals contribution margin. So we have contribution margin 150. It takes 1 hour of machine hours to make it, giving us a contribution margin per hour of 150, 1 hour times the 150, right? Or I'm sorry, 150 divided by 1. We take the contribution margin per machine hour is calculated by taking contribution margin per unit divided by the number of hours per unit. Okay, and then for the Max, we're selling at 750. The variable costs are 550, giving us contribution margin per unit of 200. It takes 2 hours to make a single Max product. Therefore, we have a contribution margin per machine hour of 100. It's the contribution margin per unit divided by number of hours. Okay, so now looking at these side by side, I need to make a decision. Which one do I focus more of my attention on in terms of manufacturing? Well, if I look at it from that perspective, I would focus my attention more on the Pro. Why on the Pro and not the Max? The Max, yes, gives me a higher contribution margin per unit, but the Pro gives me a higher contribution margin per machine hour. So from looking at it from that perspective, the Pro would be the better choice here. Leland.
Oh, I'm sorry. Apologies. I was
No,
just
you're good.
understand. So with the Pro, I'm guessing it's because you make that much. I guess does it take less time to make it, or
Yeah,
am I
it
reading
takes
this
less time to make it. That's why the contribution margin on a per machine hour basis is higher.
more? Okay, got it.
Great question. So again, doing right by the company. So in all of our decision making processes, whatever decision is that we're trying to make here, we want to make sure that we're going with whatever the higher contribution margin total is going to be. In this case, by machine hour 150, the Pro is going to be the best option. And in our previous ones that we discussed, the higher revenue, yes, we want the higher revenue. We want the best contribution margin. We want the lowest cost. So keeping those factors in mind, that's how ultimately what I'm trying to get at is that's how we make our decisions in business. So looking at our sales mix, we have the Pro and we have the Max. We know what our contribution margins look like, and the machine hours. Now we figure out, looking at it, which one would be better. So if we say, let's go with the Pro because my contribution margin per machine hour is 150, which is higher than the Max. What will be my contribution margin total? I take the number of units being produced, in this case 2,000 units, multiply that by the contribution margin per machine hour, in this case 150, gives us a total contribution margin of 300,000. We utilize 2,000 machine hours in this case. Okay, the decision here was because our contribution margin per machine hour was higher with the Pro, we decided to focus all of our efforts in producing only Pro and zero Max. So what this does is it shifts our scarce resources from manufacturing one product to preferring the one with the higher contribution margin. That's what I'm getting at. Now, if we had other limitations, meaning we only have 2,000 machine hours to produce both products, I know which one's going to make me the most. If I focus all my attention on the Pro, what's going to make me the most revenue based off of contribution margin, for sure. We know that. However, in most cases, I'm still going to sell both products. Therefore, I need to make both products. So I'll adjust my resources accordingly. So I'll make, in this case, 1,200 Pro units and 400 Max units. 1,200 times the 150 per unit contribution margin per machine hour gives me 180,000 for the Pro. 400 units times 100 contribution margin per machine hour gives me 40,000 for the Max. Add them together, get the 220, gets me to 2,000 hours total. So, but keep in mind, the Pro in this example took 1 hour per unit, and the Max took 2 hours per unit. That's where we get the machine hours from. So in that decision making process, it's a balancing act. Oftentimes, if I cut a product entirely, I'll cut the Max. But if I need to make both, I'll make both and adjust. That's kind of what we're getting at there. Now, when it comes to eliminating one of those, as I had mentioned, I'm going to cut the Max in that previous example. Why? Because the contribution margin was way lower, than the per machine hour than the Pro was, and so I go through a process when I evaluate something for elimination. So here we have a couple of parts of this process. Segment is a candidate for elimination if the contribution margin is less than its avoidable fixed costs. Yes. If I'm paying out more than I can sell the damn thing for, I'm going to eliminate it. Obviously, yeah. If there are two types of costs, as we mentioned, avoidable and unavoidable. Avoidable costs, those are the costs that I can go without if I eliminate a segment. Unavoidable costs are going to remain the same regardless of what happens. So, for example, rent is an unavoidable cost. Rent is unavoidable. I still need to pay the rent. I still need to pay the depreciation expense is still going to happen. The maintenance expense is still going to happen. The salaries of my employees that work in the office still going to happen. Those are all unavoidable costs. I still have to. If I cut the Max out entirely, I still need to pay all that stuff. It's unavoidable. The avoidable costs are the costs that are eliminated when I cut the product. So if I cut that Max out, the great news is I don't have to pay the cost of 800 machine hours. I save the 800 machine hours. I don't have to pay the incremental costs because I'm not making them. Those are avoidable costs. So in other words, avoidable costs are the costs that are related to that product that you're looking to cut. If the fixed costs if the avoidable fixed costs is higher than the contribution margin, that's a problem. We'll probably need to cut it. So let's look at this example. Okay, so here the company has 3 different segments: treadmill, wellness, and fitness. Think about this as Peloton, okay? Peloton's got some decisions they need to make. Treadmill, wellness, fitness. Okay? We have our sales minus our variable costs equal our contribution margin minus our fixed costs equals our net income. So we had already said that if the fixed costs are greater than the contribution margin, we need to look at cutting that segment. So in this case, the only segment where that happens is in our treadmill. Fixed costs are 15,000, contribution margin is only 5. It's a loss of 10,000. And I want you to think about what the avoidable costs are here. The avoidable costs, those are the variable costs. The avoidable costs are the variable costs. So here's the thing. If I cut out my variable costs, which means I also lose my sales because I'm not selling the product, I still have fixed costs of 15,000. The fixed costs don't go away just because we stop selling the product. So what do I do? Well, a couple things. In reality, those fixed costs would get redistributed across the 2 remaining segments. Yeah, but they'll still remain. So the decision is, if I cut out the treadmills, I still have the fixed cost 15,000. That means my loss would actually increase technically for that segment, right? It'd be 15 would be my loss for the treadmill because I won't have contribution margin, I won't have variable cost, and I won't have sales. So I'm going to stop
Wait,
selling the treadmill.
but what you're saying is, I'm sorry, that was wild by that. So what you're saying is, even if you eliminated making treadmills, you'd actually
Uh-huh.
lose more than making the treadmills
Correct. I would actually
because
lose
the
an
fixed
additional
cost.
5.
Oh yeah, I noticed. I noticed a little bit more. Wow.
Yeah. Yeah, because the thing is with the fixed costs, if I stop selling the treadmill, I lose my sales, I lose my variable costs, I lose my contribution margin. The fixed costs still remain.
Because it's
So
fixed.
because it's
So
fixed, it
wow.
doesn't change regardless of level of output. So in this case, my loss would go from 10,000 to 15,000.
Huh.
So I might make the decision to keep making it. And the reason for that is because I'd rather lose 10 than 15.
Yeah, if you're gonna lose, I mean, I guess if your perspective, I guess you should look at it like you're gaining 5 instead of losing.
Right.
If you maybe you should look at it if your perspective is different. Maybe you look at it differently, so it won't bother you as much.
Right. That's true. That's true. And in reality, your textbook probably says the opposite. But in reality, that 15,000 is just going to get redistributed across the rest of the company. But but yeah, I mean, in some cases, in some cases, um, you know, we would go with whatever we think the law, the if it's a law, we call it a loss leader in business. That treadmill is a loss leader. What that means is that even though I'm selling it for a lower price than I can make it for, I'm attracting customers. It's a loss leader. So that would be maybe the only decision why they might keep it. But in my business, there's no way I would keep that.
Yeah,
I would cut
yeah,
that thing so fast and then just redistribute the 15,000 across the board.
into
So
something else.
exactly. So that's what we did in this example. So you can see the redistribution after we have eliminated the segment. So we eliminated the treadmill. We spread the 15,000 fixed costs across wellness and fitness. And so we can see what those changes look like here. Now, of course, what's it going to do to our overall? Yeah, it's going to have an impact, obviously, but it was still wiser to cut it because, I mean, you know, I'm not going to lose 15,000. Just not going to happen. I'm not going to lose 10. Just not going to happen. So we cut it. So, but it's a fun exercise, I think, because it's real. It's a thing that businesses are faced with on a regular basis. Here's another one I like. the keep or replace. I'm going to give you an awesome example of this. I may have already given you this example, so I apologize if I'm just telling you a story that I've already told you probably more than once. So as you all know, I used to work in the hotel business, and we had a really big hotel property in New York. It was something like 600 guest rooms or whatever, 30,000 square feet of banquet space, so full restaurant, big hotel, right? So one day the manager of the maintenance department comes to me and says, "Hey, listen, we got a problem with a chiller on the roof." So yeah, what's wrong with it? He goes, "Well, it's getting warm out, and the chiller is breaking down. So we got to make a decision. Are we gonna keep and repair this thing, or replace it?" And so we ran out the cost benefit analysis. So we said, okay, well, what's it going to cost if we keep repairing it? It goes, oh, well, we estimate that we'll have to replace this, this, and this. And I said, how much longer will it last if we keep fixing it? Well, it could give us another couple of years. So, okay. And of course the cost was lower to keep it and just to fix it. Great. But it didn't come with many benefits because it wasn't going to last much longer, et cetera, et cetera. If we replace it, it was going to cost a whole lot more up front. Sure, I could get some scrap value from the old one, but the new one's going to cost a whole lot more up front. But was it going to make a difference in income? Yeah, maybe, probably. Nobody wants to stay in a hotel that's warm. That's right. So we had to go through the keep or replace decision. We do that periodically, and we want to make sure, obviously, our costs are as low as possible, but at the same time, we need to maintain our revenues or increase our revenues and sales whenever possible. So we go through the process. So here's an example, same type of example, just on a much smaller scale. So we currently have this machine that we've been using. It's worth about $20,000. It has a variable cost per year of $50,000. Salvage value of nothing. And I currently use this machine and I gain $25,000 a year in sales from it. It's got about 5 years useful life. Okay, great. So all that sounds fantastic, right? Oh, $25,000 a year, blah, blah, blah. Is my income, but my outflow total is super high, right? My variable costs per year, $50,000. It's only worth 20. It costs me $50,000 a year to keep it running. Okay, it's got another 5 years left. So 50,000 times the 5 years left, that's 250 grand if I keep it. Okay, doesn't sound all that great, but let's take a look at what it will be if we replace it. Okay, so what would it be if we replace it? Purchase price, 100 grand up front. Ooh, that stings. It'll cost about $36,000 in maintenance to keep it running every year, variable cost. Okay, great. So here we go in the decision-making process. My sales are $25,000 a year with this machine. So we'll keep that in mind because it's still going to be a factor, right? The cost, purchase price, 100 grand up front. Obviously, that's a relevant cost. Variable cost, 180. 36,000 times the 5 years, 180. That gives me a total loss for that first year, or total loss, I guess, of 255. I'm keeping the current machine because in this case, my loss with the current machine is a lot better than the loss with the replacement by about $5,000 difference. So again, this is an actual decision that you might come across. So now that we have a great idea about the type of decision making that we would make when it comes to those type of things, now let's talk about setting the right price. This is an art and a science, in my opinion. Setting the right price is challenging, to say the least, because it's not as cut and dry as make sure we cover all of our costs. Okay, we need to do that, but we also need to make money. So we're going to do what's called cost plus, right? I need to not only cover all of my costs, I also need to build in some profit. Cost plus. The profit is the plus. We call that my target profit. It's the plus amount, right? So companies can either be a price taker or price setter. Oftentimes, we've always fallen somewhere in between the two. Price takers oftentimes don't do so hot because there's a lot of competition. The products are very similar to each other. There's no specific branding, and there's low barriers to entry. So it's just kind of a free for all on the price taker side of things. The price setters, on the other hand, they have a little bit more control, a little less competition, a more unique products, better branding, and a higher barrier to entry. So, in understanding these differences and these variables, we can try to get an idea of what we need to set our prices for. Because we always want to take into consideration, what's our competition doing? Because we want to make sure that we're competitive in nature. So I always like the cost plus approach. Cost plus, as I had mentioned, is we're building in the markup. We're building in the target profit, if you will. So here we go. There's a couple of steps that we need to take in order to use this approach. The first is we got to determine the total cost per unit. Now, you already know what this looks like. It's the product costs, which are your direct materials, direct labor, factory overhead, plus your selling, general, administrative expenses. Those are your total costs. We add those together. Those gives you total cost. Once we know the total cost, we need to figure out the total cost per unit on a per unit basis. Okay, so we take our total cost divided by the total number of units we expect to produce and sell. That'll give us our total cost per unit. Once we have the total cost per unit, we can move into step 2, which is figure out the markup per unit, which is our total cost per unit times the markup percentage. Okay, and once we've figured out that, our markup per unit, we can add in our total markup per unit to our total cost per unit. See how that works? We're just adding in that markup in a sensible way, rather than just guessing. That's the formula. That's the approach. Another approach that businesses oftentimes take is called the total cost method approach. And basically, all it is we're using a similar type of approach, except we're considering all of our costs. We have all of our total product costs plus all of our selling and general administrative costs, gives us our total cost divided by the number of units expected to be produced and sold, gives us our total cost per unit. So very similar to the previous model. We take the total cost per unit times the markup percentage, in this case 20%, gives us our markup per unit. We take our total cost per unit plus the markup per unit to find our sales price per unit. And then another method is called the target costing method. This is what our expected sales price is going to be minus our target profit, how much